Hello, my name is Kevin Roden of Whitaker Roden & Associates, and I would like to welcome you to our presentation on strategies for your business succession. This presentation will be approximately 1 hour, which I, along with my guest speakers John Schelling and Don Sahota, will cover strategies and topics that can significantly enhance the succession of your business. I will start the presentation off by introducing myself. I am a partner of Whitaker Roden & Associates, an established public practice accounting firm in Nanaimo, BC, and our firm provides personal, corporate, and estate tax services to a wide variety of clients, and we perform audits for not-for-profit organizations. Okay, I think we can move to the next slide. So those of you watching, I would suggest maybe you pause the presentation and have a read over of this disclaimer. We don't want to get into that at this point, but you can read it over just to understand the implications. Okay, let's get started. So, planning ahead for your succession. You should always run your business with a view to selling, and even though you're running it for a view of profit in the meantime, but planning ahead always helps because you never know when you may, have an opportunity to sell your business. But the planning ahead will help you achieve an optimal selling price and also help you structure an efficient transition to the purchaser. And it can also minimize taxation, and that's what I'll mostly focus on in this presentation. Why is evaluation important? Well, as I mentioned, at any time you may have the opportunity to sell your business, particularly a random offer from a potential purchaser, but also for estate planning purposes, and one that not too many people think about, but the estimated potential tax liability upon death. So to have a value, to know what the company or the business is worth, will be easier to determine these tax implications. Identify your valuation drivers. Now, of course, the valuation drivers, the big ones being cash flow, your revenues in excess of expenses. That's one of the big ones. But the other ones are more intangible. The depth of your management team, if you've got a good customer base or a prime location, whether you've got long-standing relationships with suppliers, long-term written contracts, or really favorable loan and financing facilities. All these aspects are very attractive to a potential purchaser for various reasons. They may not be able to get their own financing, or they may be trying to increase their market share, that sort of thing. All these intangibles are more or less known as goodwill, but those are all important factors in determining the value of your business. But as I mentioned, the other value drivers is the main ones that are determining the actual dollar figure of the business will be based on things like your cash flow, your earnings before interest, taxes, depreciation, and amortization. And there's also another one that could be percentage of gross revenues. Now, we also suggest that in order to determine the value of your business, there are certified business valuators that can give you an appraisal or give you a professional opinion on what the value would be. John, I've just lost my screen.
Oh. Okay, hang on. Don, do you have the screen up?
Yeah, I think it might have had something to do with my screensaver coming up.
Okay, maybe hit your Enter key or any key.
Let me just see. Okay, let me go down. Okay, I've got it back again. Can you edit these?
No, go ahead.
Okay. Okay. The next slide. Identify how your business will sell. What we mean by that is you may be selling to an arm's length person, or you may be selling to management of the company or employees of the company, that sort of thing. But there's also a couple of ways you can sell your business. You can sell the business through the shares of the company, or you can sell the assets of the business. Typically, the purchaser will want to buy the assets of the business. The main reason is that when you buy the shares of the company, you receive everything within the company, all the baggage that comes along with it. The purchaser may be afraid of undisclosed liabilities, that sort of thing. Also, the capital assets of the business may need to be depreciated down to a very low value, which therefore provides a very little tax savings in the future, whereas if the assets were purchased by the purchaser, he would have full fair value to base his calculation for amortization on and greater tax savings. The benefit for the vendor to sell the shares, of course, is the lifetime capital gains exemption, which I'll be getting into in a subsequent slide, but it's a $750,000 exemption on any gain on the sale of a qualified small business shares. So between the purchaser wanting to buy the assets and the vendor wanting to sell the shares of the company, there'll be some negotiations. So basically, it's the after-tax or the take-home dollars after tax that you want to look at. So even though you may have your business valued by a business valuer saying it's worth X amount of dollars, there could be some negotiation in order to get the sale of the shares versus the sale of the assets. Now the lifetime capital gain election for qualified small business shares, there's a couple of factors to make sure that you, or as the vendor and the company, is also eligible. The eligibility of the vendor being the seller of the shares, they must be a resident of Canada, and they still must have available capital gains exemption left, because as I mentioned, it's a lifetime capital gain election, and any previous claims on this exemption will reduce the amount eligible on the sale of these shares. Some other reductions to the exemption limit will also includes the enable, which is an allowable business investment loss, the senile account, which is cumulative net investment losses, and then there's any current capital losses in the year of the sale, or if there was ever an election done in 1994 for the crystallization of the capital gains exemption at that time. Now, this information can generally be picked up from historical records of the company and possibly from historical records of Revenue Canada, but it definitely needs to be confirmed to determine your eligible limit. Other considerations regarding the capital gains election is there will be an effect on old age security, guaranteed income supplement, medical services plan premiums, and various income-sensitive benefits. The reason being is even though this is virtually a tax-free gain, the income comes into as reported as income on your personal tax return and deducted out in a subsequent part of the tax return. Therefore, these benefits are all determined while this income is included in your return. Another serious consideration is the alternative minimum tax, which is it's just a tax Revenue Canada puts on to sort of to get some tax out of it, but that's more of a temporary tax that we can discuss at a future time. Okay, lifetime capital gain exemptions continued. Eligibility of the company. Now, once you've determined that the vendor is eligible for the capital gains exemption, the company still has to be eligible as a qualified small business corporate with the eligible shares. So there's two tests. There's the date of disposition and the holding period. At the date of disposition of the shares, 90% of the fair market value of the assets in the company must be used in the active business. The non-active assets are such things as excess cash, investments, loans receivable, rental properties, etc., anything that's not integral to the business itself. So we would want to make sure we purify the company before disposition. The holding period is the 24 months prior to disposition, and the one stipulation in that is that during that period, 50% of the fair market value of the assets in the company are used in active business. So the first one can easily be remedied prior to the date of disposition. However, the holding period is a little harder to deal with, so therefore we suggest that's where the planning ahead comes in, and make sure you run it to sell the shares, so you make sure that it would be eligible, at all times. So now at the date of disposition, some of the ways that you can get rid of those excess assets is by paying off liabilities with the excess cash, or paying off loans, or withdrawing your shareholder loan accounts, paying reasonable bonuses, paying all your income tax installments up to date, and purchasing other active assets such as inventory, equipment, and vehicles, and that sort of thing. Those will all satisfy the criteria. So now the transition of the surplus assets, as I mentioned, these excess assets that aren't business related, other reasons for removing these assets from the company is because they really distort the value of the business. Your business has a value based on its own operations, but having other assets in there such as real estate or investments, they have their own value, but they're not part of the business. Therefore, for any purchaser, it would increase the value and also complicate the selling process, because the purchaser may not want those assets. But again, also is the taxation issues, as I mentioned. Those will have a negative taxation issues for the vendor regarding the capital gain exemption. So you can move all these assets out of the company through your shareholder loan if that's available, if you have a credit balance in your shareholder loan. And of course, there is other methods to remove some of these other assets, such as real estate, out of the company, on sort of a tax-deferred basis. One of the methods that is by setting up a holding company. Now, if the business does actually have a real estate that is used in the business, now still the purchaser may not want or may not be able to afford to buy the business and the real estate, or possibly the vendor would like to hold on to the real estate and become the landlord for the business once it's sold. There is a way that you can remove the real estate out to another company on a tax-deferred basis. Therefore, the vendor can now be the owner of the company that owns the real estate, and then they'll be free to sell the company that just has the operations of the business to the purchaser. Okay, in summary, plan ahead, be ready to go. I mean, it doesn't mean you have to be ready to sell immediately, but always keep that in mind to make sure that the company will be eligible for the lifetime capital gain exemption throughout that 24-month period. Have a valuation in mind or available, so when the time comes, you will have that. Operate the business in order to sell by generating significant cash flows, and having it run in lean and mean, therefore it creates more value to the purchaser. Assess your successor. Again, where you think your purchaser may come from will become internal, will be a third-party, arm's length person, and will it be for the sale of the shares or the sale of the assets. And of course, if it is going to be for the sale of the shares, then focus on extracting the surplus assets out, as soon as possible, or on a tax-deferred basis. And then, of course, coordinate your resources and advisors. This involves your accountant for taxation purposes, a financial planner, and of course, a lawyer for the legal aspects of the sale of the company. So that's my portion. Up next, I would like to introduce John Schelling. John is the president of TLS Financial Services. For over 23 years, John has been helping individuals and businesses, owners, build and strengthen their financial positions. He has access to a wide range of financial resources, professional networks, and extensive research facilities. John has also been involved in several business ventures and succession processes. So he will give you his recommendation presentation on his aspect in business succession.
Well, thank you, Kevin, and welcome everybody to our presentation on the business succession planning. I'm going to start off by just going over what we're going to cover, and I often jokingly sort of refer to myself as maybe the grim reaper of the presenters, because I'm going to talk to you about how to protect yourself against dying too soon, and how to protect yourself against living too long. Now, those might sound kind of morbid, but we're actually going to look at how protecting against those contingencies can not only enhance your business succession strategies, but also your financial position and wealth. So what we're going to talk about today, we're going to talk about a little bit about life insurance and how it fits in business succession. Going to debunk some myths of life insurance, creating how life insurance, we can create a financial asset and living benefits out of it, instead of thinking of it as just a cost that nobody wants to incur. We're going to look at some of the succession strategies that work with these policies. And then I'm going to flip a little bit, and we're going to look at some of the investment options that are available to you for the savings you have now and will have it as you exit your business, and basically how some of these products have been designed so you don't outlive your assets. So some myths of life insurance. Life insurance is for the young. Well, actually not true. The largest growth market is age 50 to 70. Mind you, I consider 50 to be pretty young now, but age 50 to 70 is the biggest demographic. Insurance companies know we're getting older, and they're designing products to fit our needs, which include business succession. A lot of people believe there's no benefits to me as the insured, only my beneficiaries. Well, I think in the slides that are coming up, I'll show you some of the many living benefits that you can realize as an insured on a policy, and how it can play and should play an integral part of your business succession. Now, people think it's sometimes too expensive or not needed because I'm older and I'm wealthier. Again, we're going to look at concepts where you actually recover all the costs of your premiums, and that's very rare in any insurance product I know of. But not only recover, but also enhance the wealth. And wealth and age are a matter of personal perspective, but I don't know of too many people with money that don't mind making more, no matter what age they are, no matter how much financial resources they have. Now, types of life insurance, I'm going to touch very briefly on this, but just so that we lead into the types of insurance we use for these strategies. Life insurance comes in really two basic types. And I like to draw the analogy to real estate. When you're looking at insurance, it's like renting or owning. And if you buy term insurance is simply an insurance that's not permanent. It's going to run out at some point in time. It's what we call Band-Aid or stopgap insurance. And I'm not going to talk about it too much here. As I mentioned, it's really like renting, and it really has no play in the strategies that we're going to discuss. So the other type of insurance is whole life, and like its name, it's with you for your whole life, unless you cancel it. It's permanent, and you own it, just like you rent an apartment, or if you purchase a home, you own the home and the value it represents. Now, the interesting thing with insurance is you can prepay the premiums. And what I mean by that is on these permanent policies, you can actually pay off all the premiums you'd have to pay to own the policy and have it for life in as little as 5 years or more. Similar to the way you can prepay your mortgage if you choose to, and pay down your mortgage debt and have ownership of your house sooner than the amortization schedule that you may have originally set up. The coverage, as I mentioned, is for lifetime, and it's permanent, and that means that once you own it, you will be paid that death benefit. Unfortunately, we are all going to die, and that insurance now becomes an asset for that benefit alone. But the other asset you're going to be creating is a cash account that is attached to the policy. And I'm going to be touching on that in just a few minutes on the upcoming slides. But around this cash account are a lot of the strategies that we're going to discuss, and they'll fit in with some of the things that Kevin was just talking about. So what role does life insurance play in succession? Well, the primary purpose of life insurance in succession is like life insurance in anything else. You pay a little premium to buy a large death benefit, or a death benefit much larger than the premium. And that death benefit is paid to your beneficiaries when you die. In the issue of business succession, that if your business succession plan is set and all ready to go, if you die before you exit your business or before you crystallize your succession plan, for you, basically the succession plan is over. It's crystallized. However, for the entities and the people you leave behind, life goes on. And those entities and individuals may suffer financially because you are no longer there. For example, if you're an integral part of your business or a key person in your business, it's obviously going to have some ramifications if you die unexpectedly and the business has to try and survive without you. That feeds down, of course, to your family and other members that you support because they may rely on you in whole or in part for income and lifestyle. So that insurance proceeds, they're paid to support, provide financial support to replace the financial loss that may be incurred upon your death. And I've mentioned others here. There could be other individuals or institutions or legacies that you want to leave funds to. There's also compensation for taxation. Kevin talked a little bit about that. There's a deemed disposition of your assets when you die. Now, Kevin and Don can sort of organize your company and your personal affairs so that they can minimize that or maybe even eliminate them altogether if there's a spouse involved or a partner. But understand that the taxation issue doesn't go away. It's just being deferred. And my example is, if we look in the simplest sense, if you've split your RSPs as spouses or partners for income splitting purposes, and one spouse predeceases the other, that property is rolled in, or that RSP is rolled into the other spouse's RSP at no tax. So there's no issue at the time of death. However, going forward, that you now have one individual that has doubled up on their RSP assets, and because we're in a marginal tax system, the tax consequences are going to be much higher going forward. What that all comes down to is those assets are going to be taxed much harder than they would be if they were able to be split or properly organized the way Don and Kevin had set them up. So you want to make sure you've compensated for any taxation both now and also in the future. You also want to extend coverage to your key personnel. And your key people, this is where I often see the biggest holes in these plans, is that your key personnel are assets of the company, just like your building, your equipment, and maybe even more valuable. If you're looking at internal succession to family members or employees, then that is your bread and butter, if you like, as far as having a successful succession plan. Like you, if they die earlier or predecease you or your succession plan, that could throw a real wrench into your plans financially and logistically. So you want to make sure that key personnel are covered, especially in internal succession and also external succession. You want your key personnel covered because they represent value to your company. And if they're gone, your company isn't as valuable. So you want to be financially compensated for that and avoid the financial hardships that can be caused by their sudden death or illness. And the key is, you want this protection before, certainly, but it may be appropriate after you exit. And a perfect example is a client of mine just sold a company. The payout from the vendor is over 3 years. Well, one of the big clauses that he put in was that a vendor would have to be covered by insurance in case of his death or illness to protect my client's financial interests, because the last thing he wants to do is go back to the company 2 years later if something happens to the vendor. He will be financially compensated by the insurance. Same thing for you. If a lot of family successions are long drawn out affairs, if that's the case, make sure you've protected your assets, your key personnel, before and after. So let's just look at the basics of what one of these insurance policies, these whole life insurance policies, carry. There's really two components. And the first component is the basic insurance benefit that we know all about. That's the death benefit. If we die, X number of dollars goes to our beneficiaries. But a lot of people don't realize there's also a health benefit attached to these insurance policies. And in the case of a terminal illness, for example, if you were diagnosed, if you're the insured and you're diagnosed with a terminal illness, and it's anywhere up to 2 years till death is imminent, if you like, your insurance policy will pay you up to $250,000 while you're alive in that period to use however you see fit. So you could use it for medical treatments, for traveling, for family, whatever the case may be. But this is one of the living benefits I'm talking about, and it's not very well known, but it's a very, very strong benefit, especially today with healthcare being able to diagnose illnesses much farther out and terminal illnesses, unfortunately, and also with a user pay system becoming more and more predominant in our medical system. Now, there's also attached to the policy this cash account I was talking about, and this is where a lot of the strategies are afforded on this succession planning. And the cash value, the cash account is really just, I won't go into it in detail here, but it really just accumulates the excess premiums you pay if you accelerate your premium payments and prepay your policies. And what they do is they accumulate those excess premiums over time, and inside this cash account, all returns are tax sheltered. And this is something that is CRA approved, and it's all legit. And with those, within your cash account, the funds within your cash account, you can invest those in savings accounts, you can invest them in a managed portfolio of stocks and bonds, or you can participate in the dividends that are paid by the insurance company itself. And historically, over the last 20 years, that has been in excess of 5%, and that's probably the most popular option. The bottom line to all this is that with the accumulation of cash and the tax sheltering of returns, your value of your cash account will equal to or exceed the premiums within the same period of time that you've paid the premiums. So in other words, within 5 to 10 years, your cash value is going to equal all the premiums you paid to own this policy. So this is what I call zero cost insurance, or cost recovery insurance. You really have no cost of insurance. It's your cash value equals your premiums. Your asset, if you like, for Kevin's terminology, equals the liability you paid. You own this insurance and it's cost you nothing. It's one of the only products, insurance products I know around, that offers you that option. And in fact, the longer you keep that cash account in place, that zero cost will actually turn into a very significant positive asset. So what are some of the things we can do with this cash value? Well, it could be there for a source of vendor take-back financing if you're selling in a competitive market, which is probably going to be upcoming in the next few years. You find a good vendor, but just like my client, they can't take the property or your company out all in one shot. You can offer some financing options through this cash account. It can be a source of retirement income. You can use it for employee retention. Instead of paying annual bonuses, you can accumulate cash in one of these accounts and offer it to your employees if they stay loyal and stay through retention. Last thing you want to, employees often get nervous when they hear of companies getting sold or transitioned, and this is a good incentive to keep them on board, as this accumulation can amount to quite a bit, and certainly saves the risk of paying them an annual bonus where they can leave at any point in time. If they do that with the cash value strategy, you keep the asset. One of the other things that you can do is you can actually, if you have a corporate structure, Kevin was talking about some of the extraction strategies, you can actually move or hold the cash account, separate the cash account from the policy and hold it personally, and have the life insurance held corporately. And this offers you tax advantages on the extraction of capital Kevin was talking about, and also can enhance your claim for that capital gains exemption. Now, as I mentioned, I'm going to now flip hats a little bit, and we're going to look at some options you have. You've been saving for retirement. Now you exit your business and you get a lump sum or a series of payments, and you've got this money, and you want to say, okay, I want to make sure I don't outlive my assets because I don't have this income generation or my company generating income anymore. So the options we look at, the investment options, and I'm going to be very general here. We have our standard savings account. Those are, as we all know, low yield, high tax options, slow ways of going broke, if you like. Those aren't going to yield you very much other than capital preservation. You can move on to annuities, which will give you a guaranteed payment for life, so you take care of that worry. And just for as a refresher, an annuity is where you pay a financial institution like an insurance company a lump sum of money, and in return you get an annual income. And these annuities have usually higher yields and less taxation than savings. One of the negatives, though, of course, is you lose access to the capital, and there's very little or no growth on the income. So that's one of the problems. If you put in $500,000 into an annuity and a year later say I want $100,000 out, no, you can't get it. It's locked in. You get your income. That's it. You can then do a portfolio of stocks, bonds, real estate, other various investment assets, or you can go to managed funds, which are preset portfolios for you. And you can, with those, you have good growth potential. You've got tax-preferred returns in the terms of dividends and capital gains or rental income and write-offs. You do have the flexibility of being able to go and get your assets at any time, but you don't have any guarantees on what returns are going to be. So you can't really set a bona fide lifetime income. So now I'm going to show you a hybrid option, which is called GMWB, Guaranteed Minimum Withdrawal Balance. Don't need to worry about that title. I'm just going to call it GMWB. And this is an option that combines what I think is the best of both worlds. And it's only offered by a couple of insurance companies. But what GMWB does is you invest in a managed fund, and it's managed by a financial institution, an insurance company. And you have a range of types of funds you can invest in. And they have, of course, as I mentioned in the previous slide, very good growth potential. They offer you tax-preferred returns. I've already gone through that. And, of course, you have the access to capital. And what the insurance companies have done is they've attached a notional account. And the notional account works just like an annuity. It gives you a guaranteed lifetime income option. And the dollar amount would be based on your age and your fund investment. You can start any time after age 55 this lifetime income, and you got full access to your fund capital. So it marries the benefits of a managed fund with the concerns or gives you the peace of mind, if you like, you also have a lifetime income. Also on this, the lifetime income can never go down. Once it's set, regardless of how your fund does, it can never go down. It can go up, though. It has nothing but upside potential as a result of your age, fund performance, or deposits. If you're saving for retirement or you are retired and just deferring payments off to retirement, this is a great vehicle as well, because for every year you don't make a withdrawal or access income, your future income will grow at a minimum 5% annual rate guaranteed. So it's a tremendous savings vehicle. It's a tremendous income vehicle. So just to summarize, start thinking of, and I hope I've shown in this slide, how insurance is actually an asset, not a cost. It's a wealth enhancer. So utilize it that way. There's many living benefits: retirement income, health care, vendor financing, key person benefits, tax-preferred shareholder extraction, coverage for taxation, the effects of taxation. We can do this all at zero cost. It's a full cost recovery product. The GMWB also, the investment side of the business succession planning, will give you income guaranteed for life with the flexibility of being able to get at your capital. You can have superior growth potential and realize tax-preferred returns. So that's the end of my presentation, and it's my pleasure to introduce Don Sahota. Don is a partner of Clark Wilson, a prominent law firm in Vancouver, and a member of the firm's private company transaction, business succession, and wealth preservation groups. With over $1/3 billion of cumulative transaction value behind him, Don has the experience, knowledge, and sophistication to protect his clients through the process of buying or selling a business. He has represented a significant number of clients in business succession and merger and acquisitions transactions across a broad range of industries. Sorry, Don, I stumbled on that, but I'll hand it over to you.
Okay, thank you, Kevin, and thank you, John. That's a lot of really good information. And thank you to all the attendees for listening to our presentation. I know we've had a great turnout, and that's because this is a really important topic that people need to be aware of. So maybe you can switch to the next slide. And so I've put my presentation into the form of 10 questions about business succession planning. What do you need to know about business succession planning? In my practice, I help business owners transition their businesses to new owners, and that can happen in any number of ways, which I'll get into later on in the presentation. But for those who are unfamiliar with business succession planning, I thought that I can go over these 10 questions, and it will give you a better understanding of what you need to know. And of course, in the short 15-20 minute presentation, it's a very complex topic, and I can't get into it in a huge amount of detail. So if you can go to the next slide. So the first question that I'm going to answer is what is business succession planning? And it really is the culmination of those three words. It's about your business, it's about succession, and it's about planning. You want to end up like the people in the image here, the walking along the beach, with a big bank account and no cares in the world in terms of your financial well-being. And that only comes with planning. If you don't plan, then that's not going to happen. And believe me, I've seen the good and I've seen the bad. I've seen the successes and I've seen the failures. And really, you can't wait until you have the gray hair to do the planning. You need to plan early on. In fact, as Kevin said, the minute you start your business, you need to start planning for your exit. Just by way of an example, I had one client who received an offer out of the blue for his business for $2.5 million, but he turned it down and then really did nothing after that in terms of planning for the succession. Unfortunately, he eventually contracted cancer and passed away. When the executor offered the business back to that initial interested party, they offered $250,000. So bad things can happen, and you need to plan for eventualities that can impact the wealth that you've created. So the next question is, why is business succession planning so important? Well, I've done a little bit of research on this, and 14 years ago, 18% of business owners in British Columbia were over the age of 55. In 2012, 33% of business owners are over the age of 55. So you can see what's happening out there is more and more people are getting to the stage where they're going to have to exit their business, and you need to be ahead of the curve. For most business owners, your business is your biggest asset, and you need to make sure that you put the planning in place to ensure that you realize that value. If you don't, you may end up in a worse financial position. You know, as I said, most business owners need to think about this early on, and many don't. I had one client who was actually forced to think about this because one of his suppliers required him to sell his business when he reached 65. Now that may seem strange, but this was a major supplier, and this illustrates a very important point. The supplier was concerned about the succession of this business because they didn't want their key distributor disappearing if the owner should come, get ill or not be able to carry on. So in that case, that client purchased the business when he was 50, put in place a plan to transition out of the business, and by the time he reached 65, he had grown the business from a $2 million business to a $25 million business, at which point I helped him sell the business. So planning is a good thing, and it's something that you need to do right now, no matter how old you are. So the next question is, why don't business owners plan for succession? And this comes down to the old adage that people are controlled by what's urgent, not what's important. Business succession planning is important, but it's not something that's urgent. It's not your day-to-day processes that you have to deal with at work. Your putting out fires, you're dealing with customers, you're dealing with employees, and business succession gets pushed back into the background. And then when it becomes critically important, when some event occurs that forces it upon you, you're not ready. So you need to really have a plan in place to cover off those eventualities. Like my client who passed away, unfortunately, significant value was lost because he had no plan in place. So the next question is, why do business owners need specialized advisors? And those advisors include an M&A lawyer, an M&A advisor, an accountant, a financial advisor, and there may be others. John, if you click the button, those should show up. And the reason you need specialized advisors is because this is a very specialized area. If you need eye surgery, you don't go to your general practitioner. You need to get people that are familiar with this type of work and who do it on a day-to-day basis. In my practice, I'm dealing with business owners that are selling their businesses all the time. I'm dealing with people and lawyers on the other side that are familiar with all the ins and outs and all the tricks of the trade in order to get the best deal for their client. You want your advisors to know the tricks of the trade. You want your advisors to be capable and up to speed on how to negotiate the best deal for you. And that's why you need to have specialized advisors helping you on this. When your succession is done, when the plan is done, you can go back to your regular advisors. In particular, if you have a general practitioner as a lawyer, you can go back to them. But for this specialized work, you really need people who deal with this on a regular basis. So the next question is, how long does it take? So how long does business succession planning take? Well, of course, every case is different, and it depends on what's involved, how complex it is, and actually what is happening. I could say that, as I've said already, the minute you incorporate your business, you should start your succession plan because you should have an exit strategy. Most people don't do that. So, you should think about it now. If you're selling your business, that could take up to a year, maybe 2. If you're planning for a transition, a slow transition out, it could take 5 years. It could take 10 years. So you need to set your own agenda and your own timeline, and then run through that timeline on your terms. If you don't set that timeline up, then someone else is going to set it up for you, and you need to be in control of your business succession plan. So the next question is, what options do business owners have? And John, if you click the next slide, it'll show up. You basically have a very limited number of options as a business owner. It's great that you've built a business, you've built that value, and you need to have now a plan in terms of how do you realize on that value. And so the first option is selling your business to a third party. That would be perhaps a strategic buyer that comes along, maybe one of your larger competitors who comes and buys you and absorbs your business into theirs. It could be a financial buyer, which would be a private equity company, and there's a lot of people out there in private equity who are looking to buy businesses, private businesses, and then grow them and then sell them again. It might be an entrepreneurial buyer. It may be someone in their 30s or 40s who are now trying to buy a business to do what you did in your business and create wealth for their own family. Another option is selling the business or passing the business on to children. And I'll talk about that one a little bit later, but it is an option that a lot of business owners really feel strongly about. A third option is the management buyout, and this is where the management of the company is the buyer, and because they know the business and they are knowledgeable about what's involved, they're often a good choice in terms of purchasing your business from you. There's more success with a management buyout than there is with passing it on to children, because of course the people in management are knowledgeable. Of course your children might be in management too, so that could be a situation that you're facing as well. The last option is the worst one, of course, which is you shut down and walk away from the business. And believe it or not, I've seen that happen. I've seen people who have not planned for their succession, realized that they have to do something about it, they run out of time, and they actually close their doors, and the assets are put up for auction. Now that's unfortunate, because in any business that's a going concern, there's value, and that value needs to be realized, because that's what you're going to rely on for the rest of your life in terms of your retirement. The next question is, are there any alternatives to the 4 business succession options? And there is another option. It's called the staged buyout, and that option is often related to situations where management is buying out the owners over a period of time. Now, I'm seeing that quite a bit in my practice, and the reason that happens is because oftentimes as an owner of a business, you feel beholden or comfortable with your management that helped you get to where you are, and you really want to give them that opportunity as well for themselves as you're exiting. So oftentimes business owners will pick 1 or 2 of key management personnel who will be the targeted buyers of the business. So it's all in-house. Now this can be very, very good. It can be very successful, or it can be very bad, because if your key management tries to buy the business and fails, you've got a serious problem, because your key management are now disillusioned, and maybe they'll leave, which is bad for you. So you need to really think carefully. If you're going to bring in key management, you have to ensure that they are as good at business as you are, and hopefully better at you, because they're going to be taking the reins of the business and running it, and they're probably over a period of 3 years, 4 years, 5 years going to owe you a lot of money, and you want to make sure that they are able to run the business in a profitable manner so that they're able to pay you what they owe you. Now, business succession with a management buyout is definitely something that you want to consider, and there are different ways that it can be financed. One of the problems is business management often don't have a lot of money, but in this environment that we're facing right now, there's a lot of options for them to finance the acquisition, so you don't have to take a large vendor take-back, and that way you get most of the money out, and a little bit is you have to carry to get paid out at the end of the day. The next slide is, are the children the natural successors to the business? And that is something that many business owners of private businesses really want. They really want to have their children take over their business. And I can fully understand that, and it sounds like a really good idea, but what parents have to realize is their children are individuals, and it's often the case that the child has absolutely no interest in the business. Maybe they want to be a musician. Maybe they want to be a teacher. They don't want to run a business. And as a parent and a business owner, you have to really be careful about forcing your children into a role that they really don't want. And many people try that, and they don't realize that they're doing it for their own good feeling, not for the good feeling of their children. I've talked to many children who said, I'm running the business because I'm trying to please my parent. I don't really want to be doing this. So think carefully about whether your children are the best. They might be, but they may not be. And if they are, great. But if they aren't, don't put them in charge of your business. This is one of the reasons why 70% of transitions to family fail. It only has a 30% success rate. So, I'll give you one example. I had a client who came to me after they had been involved in a succession plan, and was a brother and sister, and the father still had shares, and the brother and sister were running the business. Yet, after a period of time, the succession plan that somebody else had put in place, the brother and sister were fighting and had a difference of opinion. To make a long story short, it ended up being that the father sided with the brother bought out the sister, I acted for the sister, and the sister told me after we got the money, she said, I'm moving as far away from here as possible. I'm never speaking to my brother, and I'm never speaking to my father again. Now, as a parent, that's not really something that you want. So be very careful if you tread on this ground. You have to really consider it carefully because it could blow up in your face. Question 9. Question 9 is, what can go wrong? Well, I hope you've got the idea from already that a lot can go wrong. A lot can go wrong if you have not planned. You can end up with a lot less money than you could have had. You can end up with a broken family, and you can end up with a bad deal. So if you don't have a good succession plan and put your time into it, you're risking a significant amount. So you have to think carefully about getting the right advisors into the mix. And the last question is really, what are the biggest mistakes that business owners make regarding business succession? And I think that you've heard it many times already in this presentation. A failure to plan is a huge mistake. Don't let this wait. This is something you need to focus on now, whether you're 2 years into your business or 20 years into your business. It's important. It may not seem urgent, but it is very, very important. And the second mistake is, as I've said before, failure to seek sophisticated professional advice. That example I gave you of the brother and sister, that was a plan that had been put in place by some advisors who hadn't thought out the whole picture. They hadn't figured out what happens if the brother and sister fight. Now, if you have children, you know that your children will fight. So you need to have escape valves built into your succession plan. If you don't do that, then you're going to end up with potential litigation, potential bad feelings, and potential destruction of the family unit, which is so important to most. So those are the 10 questions. I hope that gave you a good idea of business succession, and I'll turn it back over to Kevin and John.
Okay, Kevin, well, if you want to close us out, I think we can wrap it up, and all our contact information is on the screen here.
Yeah, well, thanks very much for that, Don and John. And hopefully this will provide some useful information to any of our viewers who watch this. We will put this information out so it's available on all of our websites, and we'll all notify others when it's available. Anything else, John?
Nope, that's it for me, and just thanks, Kevin, for having us aboard. Much appreciated, and thanks to everybody out there for participating in the webinar.
Great.
Great. Thank you.
Okay, thank you.